Hello, everyone. My name is Matt Weller, Global Head of Research at City Index, and it's my pleasure today to be joined by two enterprising analysts, two deep thinkers to discuss the macroeconomic impact of the 2020 election. I'm joined by Yousef Abbasi, Director of Institutional Equities at StoneX, and Vincent Deluard, Director of Global Macro Strategy at StoneX. Gentlemen, how are you doing?
Doing well. How are you?
Yeah, great. Interesting day so far. For reference, we are recording this on Thursday, October 8th. Anytime you're talking about the election, it's a very fast-moving scenario, especially this year. We'll be speaking from this moment forward, and certainly things will be highly fluid, and we'll continue to cover it in other mediums as things develop. But let's just start with a really basic, high-level question. How do you see the general state of the U.S. election today? And let's start with you, Yousef.
Absolutely, Matt. So the consensus expectation has been for a contested election. That should not shock anyone. I think everyone understands that when November 3rd comes, considering the challenges around this election, we likely will not know who will be the next president of the United States. That has been priced into the market over the past several weeks, maybe even months. The dynamic that has really emerged since the first debate and has now carried through for several trading days and seems to be really a formidable trend has been the one where investors are positioning in the potential for a blue wave. Something Vincent has discussed in the past. I believe over the summer, Vincent wrote a piece about the potential for the blue wave with a Biden White House at about 66% odds of happening and a Democratic Senate looking more and more likely with some very, very important races just this week being put into that toss-up category. I mean, just this week, Lindsey Graham's seat was thrown into the toss-up category. I don't think a lot of people would have thought that South Carolina seat was necessarily a toss-up. But remember, Republicans need a net gain of 3 seats. Right now, it does look like they have a chance between Arizona, Colorado, Maine, North Carolina, South Carolina to gain those 3 seats on the net to put them in a potential majority of the Senate. And I feel like that dynamic has truly gripped the market over the past few weeks.
Yeah, that's a good point, and it goes beyond just the presidential election. As we've seen, the polls have been shifting more in favor of Vice President Biden in recent days. But I think the big decider, if Biden ultimately wins, is are the Democrats able to retake the Senate? Because a united government could be a very dramatically different scenario than the one we've seen recently, and then a more split lawmaking bodies that could make it more difficult to pass any sort of meaningful legislation. What do you see as the general state of the election right now, Vincent?
No, I mean, I agree with everything that's been said, and especially your last comment on really the question is not so much who wins, but whether the party that emerges the winner has the ability to enact an agenda, whatever the agenda be. And I think that's, something that we've seen in all recent elections is when you had, regardless whether it's the Republicans under the first years of Trump or the Democrats under the first 2 years of Obama, when we had total control, then when you have one party that controls everything, things happen, reflation happens, the dollar weakens, rates rise, and if we don't have that, on the other hand, like the second part of the Obama mandate, or I would even argue Trump post 2018, there's a tendency to kind of fall back in this, okay, rates go lower, the dollar strengthens, nothing gets done, and big tech does well. So to the extent that the odds of a blue wave have increased, and I absolutely agree with Yousef, it's almost as if we're back when I wrote the original piece in the summer, where the lead that Biden has built is somewhat unsurmountable, and it does look that the Senate is going to flip. Then I think your base case scenario should be a blue wave, and the logical implication from that blue wave is government is going to work again, whether you like it or not, and that is, I would say, generally inflationary and negative for the dollar.
Yeah, and I want to stick with you, Vincent, because you were one of the first people I saw researching historical blue waves, talking about what that might mean in the context of the years moving forward. It seems like just in the last week or two, again, we're recording in early October, that's become more a consensus view on the street or among investors. But I know you've been had this scenario in your brain for several months. So, what are some specific, sectors, industries, macroeconomic trends that we might see if we do indeed get a blue wave?
Right. So, I mean, historically, I think it's about 15% of the time since I think the late 19th century, where we've had democratic control of the two chambers and the presidency. And these blue waves tend to happen at like historical shifts. You can think about FDR after the Great Depression. You can think about JFK, or even Barack Obama after 2008. So what that means is that typically when a blue wave, that set a blue wave up is some sort of massive economic disruption, which we certainly have had, no question about that. And usually, except for today, that happens as equity valuations are depressed. I mean, again, think back of 2008, think back of, after the Great Depression. So typically a blue wave happens when, stocks are very depressed, economic momentum is weak, and as a result, actually the stock market has performed quite well under blue wave administration. I think the average gain is about 11% per annum, which is better than the long-term average. Now, the big caveat here is that we have seen this economic dislocation, probably more so than any other time in history, but of course we are trading, within like 4% of an all-time high, record level evaluations. So I'm not sure how the historical pattern plays out. Theoretically, I mean, what I expected in the summer was the market should have corrected before the election, and that would have created that base for the rally. But we only couple weeks in, and we still haven't seen that correction. So it might be a completely new outcome.
Like everything else in 2020, not necessarily following the historical script. Tossing it over to you, Yousef, do you have any additional insight on the blue wave scenario? And a thing you mentioned earlier, I think all of our watchers and listeners need to be aware of the potential impact of a delayed election. So how could you see that playing out macroeconomically and for markets?
Yeah, so I think in terms of the blue wave, looking holistically at the market, there are obviously sectors where you do probably need to pause because you understand that they are going to be facing higher tax rates and the potential for growth, but they're also facing a higher regulatory burden as well, right? President Trump has really championed the cause of deregulation. I think in his first 3 years, he was able to remove 8 pieces of regulation for every 1 new piece of regulation instilled. So you would assume that, for many of these sectors, whether it's financials or technology, whether you're looking at industrials or materials or energy, Biden is going to come forward with an initiative that is going to be very much to regulate on the environmental front, very much to regulate in terms of labor practices, right? So all of these things could potentially pose challenges. There have been certain spaces that seem to immediately be the obvious ones, and we've seen rallies in those already, right? So in terms of infrastructure, in terms of green energy, those are spaces where they may be getting tax incentives as well as seeing increased government spending. So those have been the first to really rally and really take that step forward. In terms of the other ones, there's going to be a process of understanding what the new regime is going to look like, what the new tax regime potentially is going to look like too. So it does get a little bit more difficult to assess those spaces. I would say a potential delay in the election. I think the market is pricing in a reasonable delay to the election. I don't think that we want to see this really push past mid-December. And I will tell you this, the likelihood from last week to this week seems to be shrinking on how long that delay will last, right? So that's comforting to the market as well. I think that any indication that there's a delay seems to be becoming minimized. I think the mail-in ballot protocol and how people are thinking about it. I think people understand now that yes, we're going to see an increase in mail-in ballots, but it's not going to be 50 or 70% of the population voting by mail-in. You know, recent polls show that it's probably going to be somewhere around 35% voting by mail-in. And historically, the last election, we saw around 21% of people vote by mail-in. So again, I think a lot of these expectations as we get closer to election day are coming more in line. And I think investors are finding comfort in that.
Yeah, that's a really good point in terms of how the odds are shifting. We have seen the polls shift in favor of Biden, especially over the last week. And what that does from my perspective is it could, if the ultimate result follows the polls that we have at this moment, which by no means is a guarantee, as we saw just a mere 4 years ago, but that could make a situation where we know a lot more on election night than perhaps we otherwise would have. I think myself and perhaps many other traders had already kind of mentally priced in that we won't know what's happening. But some states, I think Florida, if I'm not mistaken, is able to start counting its early mailed-in ballots before election day, whereas other states like Michigan, Wisconsin, Pennsylvania can't even start counting those votes until election day. So those very important swing states, in fact, the states that delivered the win to Trump 4 years ago, those ones are unlikely to be clear unless it's an absolute landslide on election night. So we'll see. I would encourage people not to necessarily stay up late looking for a result on election night, but it's interesting to see that perspective as far as how the market's pricing in that possibility. Did you have any insight there, Vincent?
Yeah, I think there are really two developments that you need to think of. One is what I would call the relief trade, which is what you and Yousef have been outlining. Oh, okay, it doesn't look as bad. You know, we're not going to go towards a civil war. We're not going to have riots, and that fear was there, right? So anything that reduces that fear, obviously, is bullish for the stock market. So yeah, it could be that the market keeps rallying into the election, and then as the election's announced, we get this blue wave. The market rallies because we removed that Damocles sword that was hanging over. Then that would bring us to the next question: what next? And I would argue that actually that would be a buy the rumor, sell the news type of event, and that's an idea that I've been toying with for a long time, which sounds counterintuitive, but is not. I'm increasingly convinced that what is good for the stock market is bad for the economy, and what is good for the economy is bad for the stock market. And if we do have a blue wave, or for that matter, even, I'm not making a political statement here. I mean, just that the Republican wave is zero, I'm not mentioning it. But what matters is if we have Washington working again, meaning being able to achieve legislation, I think that would be good for the economy, and that would paradoxically be bad for the stock market. I mean, one pattern that we've seen year after year is this massive divergence between the economy and the stock market. And the weaker the economy has been, the better the stock market has been, because a weak economy means more stimulus, means lower rates, and lower rates have a duration effect on the big mega caps that dominate the index. 25% stock market is in these 5 mega cap stocks, which are very long duration. So every time rates drop, this gets lifted. Now, if we have a functioning economy, you could see the exact opposite, right? Oh, finally, well, actually, maybe we don't need to pay 100 times earnings for these stocks. Maybe we can find growth at a cheaper price. And just because the structure of the US stock market, which is so top heavy, so concentrated in this one massive bet, the unraveling of that to me would be very negative for the stock market. So up until the election, yes, relief trade. After that, think about what it would mean if we have a comeback to normal, what that would mean for the stock market, what that would mean for valuations, what that would mean for rates. And I think that would be very negative.
I think that's a really good point, considering both the short-term impact and the long-term. As we're speaking, Secretary Treasury Mnuchin and Nancy Pelosi, the head of the House of Representatives, are maybe or maybe not negotiating over a stimulus package that in the near term is something that the market is hyper focused on. And I think if we do get that blue wave scenario, the stimulus package, even if it has to wait till January or February, would be bigger than the ones they're trying to reach a compromise on now. So in the short term, that could be seen as a bullish catalyst. But as I think Yousef mentioned earlier, there's a risk of taxes rising, there's a risk of regulation rising, and some of those longer term headwinds could impact stocks more broadly. And also, Vincent, you mentioned between the different sectors. Were you going to add something there?
Yeah, no, I would just mention the stimulus talk. I mean, that's been the talk, for 4 months. Okay, my take is not going to happen. I don't think why would the Democrats hand over a gift to Trump? I mean, things are working great for them. It's only a couple of weeks, so I don't think it's going to happen. But anyway, I don't think it's such like the market, over the past month or so, we've seen the probability of that deal, fall from, oh, sure, it's going to happen, to close to zero. The market's rallied anyway. So I'm not sure that a stimulus would, again, to go back to my theory that, what's good for the stock market is bad for the economy and vice versa. Okay, stimulus is good for the economy. Is it good for the stock market? I'm not so sure. So it could be, again, that once we do have the stimulus, actually people start realizing that a stimulus would mean eventually higher rates, eventually higher inflation, and that would really be destructive for the long duration segment of the stock market, which at this point is the stock market.
Yeah, that's a good inside baseball point, in that perhaps that stimulus, if it, to the extent it gets things closer to normal, if we see it, might benefit small cap stocks or industrials, traditional finance names, but those aren't the names that are driving the stock market writ large. And on a relative basis, even if we see certain sectors outperforming, those massive tech stocks are just so massive. They take up such a big proportion of the overall market that if those pull back, the market's likely going to pull back too. Anything to add there, Yousef? I'm sorry we cut you out for a minute or two.
No. It's perfectly great. I think Vincent has the absolute right train of thought here, right? The chances of large fiscal stimulus potentially then diminish the Fed's flexibility to continue to provide quantitative easing and monetary stimulus, right? So, I mean, there it is, right? There's the balance that's going to be at play. And then beyond that, the one thing that I want to reflect back to November 3rd, right? Let's just say we do wake up on November 4th, and we do know that the Senate is in fact flipping Democrat. At this point, is the market happy enough about that, right? Is the market willing to rally on just the Senate flip to Democrat? Because I do think that a second Trump presidency, he could potentially get more aggressive on infrastructure spending. And the Republicans who didn't want to extend fiscally and do that are now Democrats who more favorably could look at a bipartisan infrastructure and spending bill. So, I mean, there are these possibilities. So as important as it is to know the outcome of the presidential election, I think that if we know the outcome of the congressional elections, the market may continue to rejoice in the idea of stimulus, knowing that congressional Democrats are just more likely than congressional Republicans to move forward with it.
Yeah, I'm struck by that when you look at the different parties' priorities and professed objectives for the next 4 years. They both hit on infrastructure and creating jobs, and it sounds a little bizarre in our current hyper partisan environment, but there are potential areas of agreement if we can look past the near term blue side, red side takes an advantage for a moment or two. So that's a good point there as far as the Senate. The last thing I wanted to talk about today was thinking a little more broadly. What are some international global ramifications based on the Senate, based on who the next president is, and what comes to mind for me is specifically around China. Of course, the world's two largest economies, the US and China, have been at odds under Trump's presidency. I would not anticipate that changing if Trump is able to win the election. But I also might not see that changing personally as much if Biden wins the election, because there's just a general sense, based on the polling I've seen, an unease among the American populace on both sides of the aisle with China's rise. Let's stick with you, Yousef. Do you have any insight there?
Yeah, I think Biden's made it pretty clear that reviewing the China trade deal and reviewing some of the new policies that are taken are going to be important, but he doesn't have China trade policy on his 100-day agenda, right? It's a long-term approach, and a Biden presidency is very much more likely to see us view this as a multilateral agreement in a more holistic fashion. Whereas a Trump presidency, as we've seen and will likely continue to see if he wins, he tends to take a unilateral approach. He tends to look at trade deficits. He tends to use those as metrics to start negotiating trade policy, right? You would assume that a Trump who is not facing re-election again, right, would potentially get more aggressive towards China, would potentially get more aggressive with allies like the EU. Whereas a Biden presidency, you can see him attempting to work more closely with these allies and trade partners and really try to reestablish, I think, the big story. And we saw it yesterday in the vice presidential campaign debate, or vice presidential debate, which was a friendly reminder of what debates should be like. We saw it very often. You know, Kamala Harris kept highlighting the fact that America's posture globally has slipped, and a Biden presidency would work to restore America's posture amongst our global neighbors.
Yep. Good points there. Vincent, what's your perspective on the international implications?
So I've agreed with everything that Yousef has said. I mean, generally, a Biden presidency, which looks the most likely with a blue wave, is good news for international assets, bad news for the dollar. I think, you have to look at the precedent of Obama between late 2008 and 2010. That's when we see the dollar decline a lot. The Brazilian real was very, very strong. You had the Chinese stimulus kicking in as well. Europe outperformed value. So all of that, I think, is in play. Where I think what I kind of, and I'm glad you're asking the question, because that's actually my next report, is I think, let's step out of the politics for a second and the election and just look at the big picture when it comes to China. And whether you like it or not, COVID has been very China positive. At the end of the day, there cannot be no winners in a pandemic, but there are various shades of losers. Sure. And China is probably the one that has lost the least. It's the only major economy that's going to grow in 2020. I mean, one trend that we've seen over the past decade is that growth gap between China and the rest of the world kept shrinking, right? I mean, back before 2008, China typically was running at, growing at like 10% plus, while developed economies were at, 2.5%. And, China has kind of slowed to 5%, developed economies have slowed to 1%. So that differential kept shrinking, which led to underperformance of Chinese equities, devaluation. Well, that gap is now as big as it was even, back before 2008, because most developed economies, I mean, if I look at France shrinking by 10.5%. Most European economies are shrinking by 10%. The US is a little better, but, -6% is not exactly wonderful. So you get the growth argument, you get the trade argument. Hey, we did all this stuff about, the trade deal tariffs, but the Chinese current account surplus is back at a record. The bilateral trade surplus between China and the US is back where it was before Donald Trump was elected. So, and really the driver for that is really twofold for China. One is lower oil prices. I mean, China is a massive commodity importer. So the collapse of oil prices in general, the commodity complex being weaker, has been hugely bullish for China. The second part that's helping China is the fall of tourism. I mean, China has a huge deficit in its tourism balance, loses about 2% of its GDP out of tourism. And as people can't travel, well, that means that these people are going to stay home and consume domestically. So in a weird way, this has been very, very positive for China. Last argument in favor of China, actually, well, two last arguments, both on monetary policy side. One is on rates. China now is the only major economy to have positive real yields. And let me just one before last that. Right now, you have a higher real yield in China than you have in India, Brazil, and South Africa. Now you look at, what historically the real, the rupee, and the rand, these are the ugliest currencies in the world. and conversely, the yuan, it's a stable currency. It's kept its value versus the dollar for more than 30 years, massive reserves. The fact that you can get paid to own a quality currency versus paying to own something as lousy as the Brazilian real or the Indian rupee, I think is another argument. And then I promise I will stop after that. Last argument is the growth of central bank balance sheet. China's central banks, the People's Banks of China balance sheet is actually smaller today than it was in 2017. Everywhere else we've seen either doubling or tripling of balance sheets. So China, we have less money chasing fewer goods. Sorry, less money supply, growing economy. Less money, more goods. The rest of the world, we have smaller economies, larger monetary base. Over time, I think that has to be bullish for the Chinese currency and maybe for its assets as well.
Yeah, that's, if I can pick out one thread of that point, is that politics is not the only thing. It seems like it at this point, especially if you're in a swing state like I am, and you turn on the evening news and every single commercial is politics. But at the end of the day, there are these long-term secular macroeconomic and market trends that, frankly, whoever's sitting in the Oval Office or whoever has control of the Senate is not going to disrupt. And I think that's a good point to end it on in terms of general advice for listeners. I want to give a moment here for you guys to mention your research and what you have coming up on the docket here. Let's start with you, Yousef. How can people follow along with your research, and what are you watching moving forward?
Yeah, absolutely. For our institutional clients, we put out a morning note every single morning. It's at around 8 a.m. Eastern time. And we occasionally publish on macro topics or anything that's inspiring a level of thought. I tend to sometimes seek my inspiration from clients. If I see the same question multiple times, right, you clearly know that there's a focus in that direction or something of that nature. The Twitter handle is real nerd on the street. If you want to follow, let's have some fun on Twitter. Maybe, there are some other characters on there you could follow, but at real nerd on the street, that's me. And yeah, I mean, I'm always available on Bloomberg as well. So looking forward to more of these for sure, Matt.
Yeah, me as well. Thanks, Yousef. And Vincent, what about yourself?
So I'm not as prolific a writer as Yousef. I only work once a week. Must be the French thing in me. What I try to do is I try to write kind of long thought pieces on, as you mentioned, more the secular trends. Try to not get too caught in noise, and in a way, it's because my audience is mostly institutional investors, pension funds, people who need to think about risk premia over term, correlations between asset classes. And really, they have a tough job. I mean, I'm convinced that, over the next decade, I mean, we will see what I call the nuclear winter of the 60-40 portfolio, that the kind of returns that we've been accustomed to are no longer going to be there. The kind of correlations that we've been accustomed to are breaking down and will keep breaking down. And I think it's extraordinarily important for investors to prepare for that scenario. There is behind that a case for active management, which again is quite different from what we've seen in the past decade. As far as following me, same as Yousef, it's institutional research. So the best way is to open up a trading account with StoneX. We do pretty much everything, and we're pretty competitive. So that would be my my first advice. And then, as Yousef mentioned, Bloomberg and Twitter. My Twitter handle is @Vincent Deluard, first name, last name, and I tend to be quite active, and I found that to be a very good way to engage with people. And actually, you can have smart conversation on social media. So I will end on that very positive note.
Yep, you just got to stick in the right circles, and I too have been impressed with the quality of the conversation in finance Twitter. It's its own little niche, but there's certainly a lot of intelligent people, including you two gentlemen.
As long as you stay out of politics, just don't throw electoral red meat. Stick to what you know. Talk about the markets. Bring new ideas, and you'll see that people actually have a strong appetite to talk about real issues rather than the stuff that divides us.
Yeah, exactly. You almost have to put a block on any tweets containing Trump or Biden for this month of the 4-year cycle. But thanks again, guys, for your time. Really appreciate it. Want to encourage all the listeners and viewers to be sure to like and subscribe to our channel. Like this video. Again, subscribe to our channel. That really does a lot to help us stand out amongst the crowd. And it tells us, as you guys have mentioned, in terms of feedback on social media, that's a good way of showing us that this conversation was valuable to you, and a good way of allowing us to encourage our bosses to do more of these, because I've really enjoyed it. So thanks again, everyone, for your time, and we'll be back soon. Cheers.